Understanding the risk-reward ratio is one of the most fundamental principles in trading, yet it is often overlooked by many traders chasing quick profits. At its core, the risk-reward ratio is a measure of how much potential loss a trader is willing to accept for a given level of potential profit. It is a simple concept in theory, but its application requires discipline, analysis, and a clear understanding of market dynamics. When you enter a trade, you are making a calculated bet, and that bet involves both sides, the upside and the downside. The risk-reward ratio quantifies this relationship. For example, if you are willing to risk $100 to make $300, your risk-reward ratio is 1 to 3. That means for every dollar you risk, you expect to earn 3. But understanding the ratio is not just about setting numbers, it's about aligning your trades with a consistent and disciplined strategy that respects both the potential for profit and the potential for loss. Many traders fail because they ignore this principle. They enter trades without a clear idea of how much they are risking relative to the reward. They let emotions drive decisions, chasing profits without calculating the potential consequences of a loss. Over time, this lack of discipline erodes capital and confidence. The market has a way of teaching harsh lessons to those who underestimate the importance of managing risk relative to reward. Applying a proper risk-reward ratio begins with careful analysis of the trade setup. This involves identifying key levels in the market, understanding volatility, and anticipating potential price movements. You ask yourself, where will I exit if the trade goes against me? And where will I take profits if it goes in my favor? Without answering these questions in advance, you are essentially trading blindly, leaving your success to chance rather than strategy. Consider the story of Lisa, a trader I once consulted with. Lisa was highly skilled in technical analysis and had a keen eye for identifying opportunities in currency markets. However, she struggled with consistency because she often entered trades without a clear risk-reward framework. One week, she took multiple trades with little thought to the potential downside. Some trades were profitable, but a few large losses wiped out the gains of several smaller wins. It became clear that without a disciplined approach to risk-reward, even her technical skill could not protect her account from volatility. Lisa decided to recalibrate her approach. She committed to only taking trades where the potential reward was at least twice the potential risk. This required her to be selective, often passing on opportunities that did not meet her criteria. At first, it was frustrating because she was trading less frequently, but she quickly realized the value of patience and selectivity. By aligning every trade with a clear risk-reward ratio, she was able to preserve capital while gradually building consistent profits. The concept of risk-reward also intersects closely with position sizing. Knowing how much you are willing to risk on a single trade allows you to adjust the size of your positions accordingly. This ensures that even if a trade does not go as planned, the loss will not jeopardize your overall account. It is a powerful tool for maintaining both financial and emotional stability, as you are never exposed beyond what you have deemed acceptable. Another critical aspect of risk-reward management is the ability to adapt to changing market conditions. Markets are dynamic, and what initially appears to be a favorable risk-reward setup can shift quickly as new information emerges. This requires vigilance and flexibility. Traders must constantly reassess the balance between risk and reward as the market evolves, adjusting stop-loss levels, profit targets, and position sizes to maintain a favorable ratio. To illustrate this, imagine a trader named David who focuses on commodities trading. He identifies an opportunity in oil futures with a potential profit target of $500 per contract, but the potential loss, if the market turns against him, is $200. The initial risk-reward ratio is favorable at 1 to 2.5. However, unexpected news about supply disruptions causes extreme volatility, pushing the potential downside risk to $350 while the potential profit remains the same. A disciplined trader, applying the principles of risk-reward management, would reassess the trade, possibly adjusting the position size or even exiting, rather than holding blindly. This proactive approach protects capital and maintains strategic integrity. Emotional control is another benefit of a proper risk-reward framework. When traders know that their potential losses are contained and that the trade aligns with a logical, predetermined reward expectation, they are less likely to make impulsive decisions. Panic exits, revenge trading, and over-leveraging often occur when trades lack a clear risk-reward plan. By contrast, a consistent application of risk-reward principles fosters confidence, discipline, and resilience. The lessons of risk-reward are reinforced when reviewing trades after the fact. Successful traders maintain detailed records of their trades, analyzing how well each trade adhered to the intended risk-reward ratio, and identifying areas for improvement. This feedback loop is critical. It transforms risk-reward from a theoretical concept into a living part of the trading process, guiding decision-making, building consistency, and improving long-term performance. In essence, the risk-reward ratio is not just a numerical measure, it is a mindset, a philosophy, and a framework that shapes every aspect of trading. It teaches patience, encourages selectivity, and ensures that every trade aligns with a larger, coherent strategy. While it may seem restrictive at first, it ultimately empowers traders to operate with discipline, to protect capital, and to achieve sustainable growth. Traders who master risk-reward do not fall prey to the allure of chasing quick, unpredictable profits. They understand that the market is a long game, where consistency and discipline outweigh short-term wins. By committing to a favorable risk-reward ratio on every trade, they build resilience against inevitable losses, maintain confidence during volatility, and maximize the probability of achieving their trading goals. Ultimately, the risk-reward ratio is a trader's compass. It provides guidance in uncertain markets, a benchmark against which every decision can be measured. Without it, trading is no more than speculation, driven by emotion and chance. With it, trading becomes a disciplined pursuit, a strategic practice where the odds are managed, losses are contained, and profits can compound over time. The art of trading, in its truest form, is not about avoiding risk entirely, but about understanding and managing it intelligently, and the risk-reward ratio is the single most effective tool for doing exactly that.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.